Now I have the results. We made roughly 200,000, give or take a little bit more. So that's pretty impressive. Shows that you don't need to be trading with a really big account. I had my account above 50,000 and I'm dealing with 4 to 8K risks at max. What is going on YouTube? I am Mike Huddy here from clovertrading.io. Today we're going to do an in-depth yearly review specifically depicting all of my patterns and strategies that have led me to have such an awesome year. In front of us today we have my cumulative P&L for 2024. And there's a couple of things that I'm really proud about this year in terms of my goals, what I set out to do, the specific equity curve. And I want to kind of touch on all those aspects as we go through this video. So sit down, grab some popcorn, and get ready to listen in. Yeah, we're going to go over my goals first, but I just want to talk about this P&L curve before we go into the goals. I've been trading for roughly 9 years, and I've learned throughout my time that it's not really about the profits. It's about the process. And this year has really established that in my mind, and I feel like I presented that in my work. I'm not really here to be the biggest trader. I'm not here to be the best trader. I'm just here to be the best trader that I can be. I've been humbled so many times in the market that I think it's dangerous. So first of all, yeah, this equity curve that we have in front of us, just from a glance at it, you can tell that there's not really any severe drawdowns. Yes, there are moments where patterns don't perform as well. There are months where patterns kind of break, but if you're trading with real edge that's been backtested throughout the test of time or as far back as one's backtesting ability can go, you know that there are moments where patterns don't perform well, but again, when there's edge, it can come back. So really proud of that equity curve, hoping to, for next year, do a bit better. And how am I going to do a bit better? Well, this equity curve is really just my first year with trial and error. I've been creating a new pattern. For the most part, I've been using consistent size when trading that pattern. This year, since it's proven to be successful for me, I'm going to now attempt to compound the strategy and see how parabolic I can make this equity curve go. And that might be horrible. That might be great. We're going to see by the end of 2025. So let's go into my goals. I'll kind of read them out loud to you. I think the most important goals that I have here are these bottom ones. So it says follow the day one gapper system. So this is the new pattern that I've created. For the majority of my career, the patterns that I trade have kind of changed. As a trader, you have to optimize. And every 3 years, it feels like I go through some kind of shift in what my approach is and what my main focus is. So follow the day one gapper system setup that I have created. Again, I created it December 2023. It took me about 6 months before that to kind of create what I wanted to do. And then in December, I kind of established for myself from January 2024 to December 2024, I want to specifically trade that setup that I've been creating. I wrote this in my goals section. Follow the day one gapper system. I lose less on the day one gappers than I do when I discretionary trade the framework. What is the framework? We're talking first red days, breakouts, first green days, long kiss goodnights, just the general patterns that stocks go through when they go through a really hyped up cycle of volatility. I found that I was losing more on that stuff, which used to be my bread and butter, and losing less on day one gappers, meaning had I just stopped trading them and just focused on day one gappers, then I'd be in a more profitable situation. And it was really hard for me to do this. It was really hard for me to take what I've been really trading for the past 7 years and say, I'm going to ignore a ton of that this year. And it reminds me a lot of how I first became consistently profitable, which was specifically realizing that, back in 2017, I was negative going long on stocks and positive short selling stocks. So I had to create pretty much sticky notes every day that said, hey, Huddy, do not buy a stock. You suck at it. Do the thing that's making you money and stop doing the thing that's making you lose money. And it's very hard to ignore long bias patterns. You see people in chat rooms making money. You see people, bragging about how longs are the best and shorts are, scary and dangerous. And it makes you want to maybe follow the crowd or whatever it is. And what I found in my trading is you really have to make it personal and about yourself. Follow the day one gapper system. You lose less on this than discretionarily trading. What's the intention? 10K position sizes make how much money end of year? So if I had 10K on the gappers and pretty much on every kind of strategy that I'm taking, 10K is the equity. It's not the actual risk of what I'm putting in, but 10K is the equity. If I have that type of position size, what is going to be my end of year results? Again, that's what I wrote at the beginning of 2024. Now I have the results. We made roughly 200,000, give or take a little bit more. This is before fees. And again, that was with consistent size throughout the whole year. So that's pretty impressive. Shows that you don't need to be trading with a really big account. Although sometimes my risks were in the area of $4,000 to $8,000. So it's not just that I had a 10K account. Generally I had my account above 50,000 and I'm dealing with 4 to 8K risks at max. My next question was, I had the foundation of day one gapping craps of how I wanted to approach them, but I know it wasn't perfected. I knew that there was so much more to do with the strategy, but I just had to get my feet in and start trading them and watching them every day to start uncovering what other patterns there may be. So my next, kind of moment, my thought process to myself was figure out how to get cute with them without compounding the losses. That's really important. I don't want to compound losses. So questions I had for myself: do I need to short the spikes? Do I need to add to broken down charts after the first hour? Is there a time frame component? This one's really important, and I think most newer traders need to focus on this. Master one strategy at a time. This year for me, it's day one gap ups. That's going to be predominantly my sole focus, and you're going to see that in my numbers in just one moment. You're going to see how many day one gapper trades I've taken versus the other ones, and there's a lot more. That's been my focus. I'm willing to miss the other version A+ framework trades if the gappers are there. That's my focus. I'd rather not lose money at this point in my journey than make big money. I'm looking for consistency. I'm not looking to, make 100K on a specific trade. I've had that goal in my past. I've made 100K in a day. It does not do me any good. In fact, it's really negative towards my emotion because you have to follow up that type of betting structure consistently in order to see, the multiple $1,000,000 years. And I found that money didn't really make a difference in my life. And in fact, it weighed very heavy on my psyche to be putting that much money in the market and trying to push myself to those limits. As I get better with day one gappers, I want to switch this so that I start making big money or lose more often, meaning play with sizes or risk levels. So that's just pretty much me saying I want to eventually play with the risk reward. But when I was first starting with this strategy, it really wasn't about risk reward. It was just a very simplistic wide net approach and then expanded upon that as the year went on. My expectation is to sacrifice win rate in order to obtain better risk reward. That actually ended up not being true. As I found a way to better my risk reward, the win rate actually went up. So I found a better version of the gap and crab strategy, which we'll talk about, but it didn't have to sacrifice the win rate. It just pretty much, there's less of a sample size, but when they come around, the risk reward is better. So those were the goals, again, predominantly on the day one gappers, and we're going to look at the numbers in a sec. First, my yearly review. As I said, this is again before fees. Overall P&L was $212,000, 51% win rate. Average win was 24%. Average loss was 11%. So kind of that 2-to-1 risk reward ratio. The average net gain versus the average net loss is showing a profit factor of 4-to-1 rounded. That is because there are some trades that are serious outliers, specifically looking at the bigger cap stocks that we had go absolutely parabolic. We're talking about SMCI, which is this trade up here. This isn't the whole trade, but on SMCI, when it went to 1,000 the first time and had that first red day, another aspect of where I pushed myself in the market, I told myself that I wanted to start trying to trade my patterns with options when applicable. When I'm trading stocks under $10, I'm not really trading the options, but when something like SMCI is going to $1,000, that's one that I was interested in trading the options with. So kind of breaking that barrier and pushing myself to learn a different instrument to take advantage of the same patterns that I already know. A couple of these trades, just the net gain is insane because of how much the options actually went up percent-wise. And that helped me have a really big profit factor at the end of the year in terms of net gain versus net loss. I came from OTC land. That's where I really found my initial profitability. Look at the difference here. I've only taken 4%, 5% of my trades are OTCs. Now, there are some profitable OTCs and they do add to the bottom line. We can see that I've made $34,000 in OTCs out of my $212,000. So roughly 15% of my overall profits are still OTCs. They have an amazing profit factor, 5. And when I trade them, they're just not around that often, as you can see. So what did I have to do when OTCs dried up? I think a theme of this video is going to be optimization. I had to optimize. I had to find new strategies, create new strategies in listed world because listed and OTC do not act the same. So I had to adapt because OTCs are pretty much dead. I think the framework is so good for OTCs. When it comes to listed stocks, there's so much more choppy. There's so much more behind the scenes going on in terms of who's involved and who's manipulating the stock that the dynamics aren't the same. And although the end all volatility cycle can be very similar and reflective of the framework, I still think it's harder to trade on listed than it is OTC. Listed overall win percent, 51%. P&L from them, 177,000. Profit factor, 1.57, which again, I think is decent. I don't know how much better I could really make that. Again, we'll see by the end of next year. I have ways of getting tighter risk reward. I have ways of compounding the account within my betting strategies that I've set up for this next year. So I'm very curious to see what the 2024 to 2025 numbers are in 2025 to 2026. Going down to my long win percentage, again, I'm not really a long bias trader. I don't really consider myself one, but there are great breakouts. There are great sector moves within small cap, and I definitely want to be present and playing them if there is either a good catalyst or maybe a good market that is helpful to a long bias trader. So 31% win rate. I expect a lower win rate on my longs versus my shorts. P&L, 36,000. So again, 15% of my year comes from the long P&L, but now we get into the shorts where predominantly that is where I find the most amount of edge for my style of trading within the market, winning almost 60% of the time. Most of my profits coming from the short P&L, and that's what kind of makes up my year. So this isn't all my day one shorts. This is kind of a confluence of just gapping craps altogether. So the P&L on the day one gapping craps, again, most of the time using about, I want to say $3,000 to $5,000 in risk, made about 98,500. The win rate is 63%. I kind of expected a 70% win rate. So since I'm at or around that level, that means that for the most part, I've been disciplined in my approach and I've been doing my best to mimic what the strategy I set out to do kind of predicted the win rate to be. I'm a little bit under. And that's because sometimes there is human emotion and I will either take myself out early or not take a trade or whatever it is. Now, my gapper strategy was never good risk reward. And you can see that in the average dollar gain to average dollar loss. I'm pretty much at a 1-to-1 average gain to average loss. And you can look at it in the percent gains too. They're about 1-to-1. Since I have a better than 50% win rate, I kind of come out on top. And at the end of the day, since there are so many of these, my profit factor also ends up working out in a way that I am profitable on these. So, but the rudimental, the base foundation of my gapping craps are not much better than a 1-to-1 risk reward. But this, so far, pretty proud of. It's absolutely in line with what I expected. I actually made more money than I expected to make through this strategy. I expected 80,000, so it came out to 100,000 given the size that I was taking and given what I simulated for myself at the beginning of January 1st, 2024. This is kind of the end of the year review. So really proud of that. Look how many trades I took, 272. That's how many system trades there were for me this year. So the next one I want to go to is the first red day. Now there are technically 2 or 3 different variations of a first red day that we're going to see within the patterns at the bottom. P&L for the first red day is 51,000. So again, out of that 212,000, 25% roughly is first red days. So it's definitely not a strategy that I want to get away from entirely. There are still great opportunity within first red days. The win rate, nice, right there at 57%. Average dollar gain, 1,400. Average dollar loss, 600. So about 2-to-1. Same with the percent gain to the percent loss, 18 versus 30. Profit factor, 3.38. Gross loss, 21,000. Gross profit, 71,000. So again, when you're talking about framework patterns, from my experience, your risk reward should definitely be better than taking, because oftentimes within the framework, you're going to have tighter risks. So if you're doing your job of sizing incorrectly, this is what I would expect it to look like. I would expect that the risk reward to be a bit better and the win rate to be a little bit worse, because when you're getting tight risk, there's times where you're going to be wrong on your timing and you're going to stop out and you're going to have to find another trade within that setup to get your size back and risk another level. 88 first red day samples. So again, compare that to the gapping craps, 272. I am taking far less first red days than gapping craps. And first red days are the strategy that I first became consistently profitable with. This used to be the only pattern that I traded in the market in between 2017 and 2020. Oh, how the times changed throughout, a 5, 6, 7 year period. But I'm still trading them. It's still applicable. First red day is still a great pattern to trade, and I will continue to do them into next year. What I think is most important is, again, it's the option side of the first red day. You can see that I had a 349% gain on MSTR, buying the puts at 285 and selling them at 1343 on 1121. So you pull up the chart on that day to check it out. I think having more A+ type of size in this type of situation is really going to add to that bottom line of my P&L, knowing that this is a strategy I want to continue doing, knowing that it is 25% of my year. How can I improve it into next year? Well, I'm looking at it right now. This year with the options, I didn't go too big. I'm really in that optimization and testing period. But since I've proven to be able to handle the swings within the options and follow my plans as if I'm in the commons, I think coming into 2025, one of my bigger goals will be to use my normal 1R risk that I use on the gappers for the options trades. And I'm pretty sure that this number can be 4 to 5 to 6x bigger every time I see one. And there's not that many that I had throughout the year in terms of the options trades here in these stats, and they can really make a difference. Breakouts. Now again, I don't really consider myself a breakout buyer, but it's hard to argue with the data. Like, there is great risk reward. There are great patterns within the market that are breakouts. But what I have found is that the more trades that I take with breakouts, with long bias patterns, the worse it is. Going through my stats, 48,000 of my year are from breakouts. So another 25%. It's not a strategy I really want to get away from, but I know that I have to put a tight leash. Look how many I'm having per month. 2 in the month of December. 3 in the month of November, 1 in October, quite a few in September, and they're all losses. 2 in August, 2 in July, but we can see there are cycles where they perform very well, and I think there are some extraordinary wins, specifically Fannie Mae was a great breakout for me. Average dollar gain to average dollar loss. What we're seeing here is the best profit factor I am getting from the long bias trades. Again, taking advantage of the risk reward. The average percent gain I have is 30. The average loss I have is 5%. That is absolutely incredible. 65,000 gross profit, 17,000 gross loss. This is a pattern that I will continue to do into 2025. But again, I know that it's a quality over quantity thing. 64 trades, that's probably too many that I want in terms of the year. It's less than the first red days. It's less than the systematic trades. And arguably, I've missed a lot of breakouts within December. It's been a very hot cycle for breakouts, but I've been traveling and trading, and it's kind of hard to really buy breakouts intraday when it's, midnight in Asia. So that pattern has probably suffered some of the performance it could have had. The next really important section of my trading for 2024 is the miscellaneous pattern. Now, these are the random trades, the big no-nos. These are the ones that, the losses are so not acceptable. They're undisciplined losses. They don't generally fall within a pattern. They're anticipatory, or they're chasey, they're FOMO-esque. They're all filled with these emotions that cause us to push the button when we're not supposed to. So what have I done? I've created betting strategies that when I take losses, my betting strategy is based off the equity in my account now. So now when I take a undisciplined trade and I experience a loss, what it does is it allows me to bet less the next day. And if I want to compound my accounts, that is absolutely not acceptable. I'm very excited for next year to see how much less trades I can take. 128 trades this year that were considered random. Minus $36,000 in profit. The win rate is 17%. The risk reward is negative. Although I'm doing a great job at cutting them and not letting them become the outlier losses. This is not where I want the outlier losses. I want an outlier loss on an A+ pattern that has gone wrong. And although that shouldn't really happen on the A+, it will happen. It happens occasionally. And that's where I want my outlier losses, because I'm pushing size where it is appropriate. Cutting those losses, well, that's good. Again, gross loss, 52,000, gross profit, 16, with a profit factor I consider negative 0.31. So a lot to improve on this page. And I feel like towards the end here, I did improve. You can see the dollar amounts really came down. Whereas kind of in the middle of the year, you see some 4 figures and even some bigger ones at the beginning of the year. So yeah, next year, really hoping to cut down on some of these miscellaneous trades. And thankfully I have, and thankfully I've cut most of the losses to bare minimum and the sizing really down. But 36,000. 15% of my year is in unnecessary, undisciplined trades. OTC pump and dumps is the next pattern that, there's only been 4 this year, so doesn't really add to my bottom line, although it is 10K. It is 100% win rate, but there's only 4. So not much I can really derive from this. I will still take the occasional OTC pump because the win rate is 100% for me. China pump, those China liquidation plays, the hollows, the MLGOs, my goal for this year was to stay away from these. I no longer want to trade anything that's really China related. I had some great wins in 2022. I had some horrible losses in 2022. And it created some of the more volatile price equity curve I've ever seen in my life. I'm talking make 50K, make 60K and have kind of a record trade. And then lose 40K, lose 60K and have a record losing trade. I don't really want to trade them. I only took 3 trades this year. Surprise, surprise. I'm I guess, profitable, but the number is ridiculous. It's not even worth going over. But again, reaching my goal. My goal was to not trade them. Parabolic short, not something I really know how to time all that well. And even when I time them, I'm not very good at sizing into the risk level with an appropriate 1R risk when the time comes, because what does parabolic short rely on? It relies on price action, intraday price action, and it relies on level 2 tape reading. Two things I am not very good at. And I also don't really scan intraday. So a lot of these that I'm going to just mix, and I'm not going to be able to play the numbers game within how many of these actually show up. You can see I even have a thought blurb. Like, I don't really scan for these, but maybe I can look for them on the day one runner charts. And that actually ended up to be a profitable thought blurb for myself. And this is the importance of having a journal, because I can write these notes to myself, kind of like a watch list, and allow myself as I trade day in and day out to start to work on and expand upon these thoughts. So parabolic short, I'm not very good at reading price action. I'm not very good at scanning for intraday action. I'm not very good at reading level 2. Therefore, I don't really trade them very often, although kind of a profitable endeavor for me this year. Made 3,500 with a nice win rate. But at the end of the day, 3,500 is 1.5% of my total profits. This is not what's adding to the bottom line. I will probably expect to see maybe 2 or 3 next year on this parabolic, because I have found a way to short them as day one gap and craps when they apply. And I think that's how I'll take advantage of them, because a lot of times you'll see these stocks gap up massively and run out of the open, they'll just start parabolic spiking. And I have, through data, found a way to come in on the backside of that parabolic spike, not time the front, but time when it is most likely to begin fading and give me a winning result. And so it's not going to be the best risk reward. My arrows will for sure never be at the top of the chart, but I will be involved in some of the best parabolic spikes out the open. That's what we're going to be doing. Parabolics will be no more for Huddy. Panic dip buys. Intraday price action necessary. Level 2 reading necessary, meaning it's not a pattern for Huddy. The coolest thing about the market is just because it's not a pattern for me doesn't mean that someone doesn't make money on them. It just means that I don't. I make money elsewhere. And there's so many areas to make money that just because someone else does it really well doesn't mean you have to do it really well. You have to find the patterns and the strategies that work well for you. This does not work well for me. I can't size into the levels. I can't get appropriate risk reward. I can't time them correctly. So they never end up being a big contributor to my overall P&Ls. So I have completely ridded them from my trading. Overextended gap and crap. Again, this is one that I've kind of just merged into first red day as the year went on, because I don't really have a good enough approach to the overextended gap and crap first red days where I'm shorting at the open. Oftentimes, I'll miss the initial move of the overextended gap up short. And then when it has its intraday bounce short back into the key level, and I have some type of proof that the chart is broken and that we are on backside, I will take the higher conviction entry with worse risk reward when it's red on the day. Therefore, it is a first red day and not an overextended gap up short. So that is why I've kind of moved them all into the first red day short pattern, because if I am too short an overextended gap up short, most of the time I'm getting chopped up and missing the initial move regardless. So getting rid of that section. Long kiss goodnight. Again, not really a pattern I trade, but on some of the more dilutive and toxic stocks, I will kind of come back for more as I see lower lows being created. But you can see even here, I didn't really do it. I honestly hardly consider these two trades. I think this was more of a thesis and I didn't really swing it long enough to see it through. And then it's really just FFIE where, I understood the dilution. I understood the chart. I understood the daily chart price action very well. And I kept just kind of sizing in and swinging for the fences on some size when I think specifically here they had a fundamental reason to go down. They were extended, from 4 cents to, I was shorting this at $1.13. So it was still very high off the lows. They had earnings coming out. What else was coming out with that earnings? They were going to unlock more dilution because they were putting out their earnings for the first time in a year, a chance for them to increase their authorized share count so that they could dilute more. And again, that's more than just a breakdown for me. That's also a fundamental thesis. Although I've seen Kyle Williams nail some of these further breakdown charts. So it's something that I'm willing to have in my stat sheet, but understand that this is really just one trade. Daily bounce short. So this is when we've kind of had our first red day already. And then the first green day has happened as well. And we're now gapping back into the previous levels. And it's kind of like the short into resistance, bounce short, lower high on the daily chart. I found that, well, I don't really trade these all that often. And I have a mixed bag of results and they don't add to the bottom line. So this is one that I'll stop doing, or at least I'll stop labeling as a bounce short, because there are times where, let's say we have a very significant first red day and the stock goes from like $4 to $1 in one day and retraces its whole move. A lot of times you're going to see a bounce off those lows as shorts come to cover, as longs come to buy the dip. And in the cases that those get overly bought into overbought territory, they will start to transition into my gap and crap type of setup. So instead of having a bounce short, again, individual page, I'm just going to merge this with day one gap and crap shorts. And when they fit the criteria of the day one gap and crap shorts and they're also a bounce short, maybe A, that's a better day one gap and crap short that I should look into, or B, they're just going to be a day one gap and crap short and I'll just treat them like the others. So I think this page is a bit unnecessary and we'll get that nice delete button after this video. Sector swing. This is one that I really try to get away from. This one used to be a lot of fun for me, especially in like 2020 and 2021, where, you know, if there was a really hot sector, I would go find pretty much all the low floats that had looming breakout charts and decent share structure, and I would just buy them and sit in them and wait for them to start PRing and wait for them to go. Again, this one was horrible for me. I hate buying stocks that are illiquid. I hate buying stocks that are at their lows. I hate buying stocks that aren't moving. All of that is a lot of good faith, and that is not how I like to trade. It's out of my control. I'll probably delete this after the video, and if I do a sector swing, it'll go into the miscellaneous section, and it'll be labeled miscellaneous sector swing, and I don't want to do them. Midday bounce short. Again, this is just not something that's filled out very well because they're just kind of part of the first red days now for me. They're all in the same box. Whether I take them at market open or I take them in the middle of the day, it's still a first red day. I don't want to create extra work for me. This will be getting the big old delete button. Day one runner. This is basically a gap and crap that pushes a decent amount off the open price, and then I'm looking for some type of lower low or breakdown later on after we've squeezed out all the open entry shorts and got a lot of longs involved that like are saying that, oh, look at the bullish price action, this thing is going to go higher. I have the data that says that a lot of them are still going to fail. This was more of a testing sheet because it's like I'm still shorting the day one gap and craps, but I found another entry for after they push really far off the open. What I do now is I kind of do half size on the gap and crap and then another half size after they go parabolic. And in this section, these are the ones where I find myself sizing into high a day and finding tight risk. What I'm just going to do is this whole page will just get merged with the day one gap and crap shorts because that's really what they all are. I'm just entering at two different moments within the same chart. This is overextended gap downs. So first red days, we saw overextended gap ups that go red. These are the ones that start red and go lower. Again, this is something that I've gotten kind of away from trading. You can see there's only really 14 this year. And this used to be my number one traded strategy, but it started to not work as well, or the timing of which I have to get in on these is different than what they used to be. So I no longer really want to have this own page for overextended gap down. What I'm going to do is kind of like the miscellaneous trades. I'll have the first red days. And if I really want to define that type of entry that I took, I'll kind of just first red day dash gap down or first red day dash gap up. If I really want to be specific and know pattern within pattern, how am I doing on the gap downs versus the gap ups? But I think overall, they're just first red days for me. I'm giving myself more work by over defining what they are. So those are all the patterns. That's how my year was kind of formulated and how I got to the overall P&L that we saw. I hope that this video adds some value and some insight into how you guys should be at least cataloging and keeping data about your trades and about your performance, and then taking the time at the end of the year to really reflect on what is really moving the needle and what is not moving the needle in your account. The tool that I'm using in this video, it's called the Money Sheets. Kyle Williams created it with a 6-hour guide on how to use it. I think it's the best trading journal in the business. So that's where you guys can find us, clovertrading.io. We hope to see you there, and let's all get ready to rock and roll and have a beautiful 2025 and improve upon what we were able to create in 2024. Peace out.